Hi everyone, it's Jack about another video. Today I'm going to be doing a stock analysis, quick 5-minute analysis on Okta, cybersecurity identity provider. Up 4 times since its IPO in 2017, even at this depressed price right now, down 55% this year alone. That's just from January the 3rd. And that is even after a nice 25% bump from its middle of May bottom so far. Stock's sitting around $100 right now, $15 billion market cap. Let's have a look a bit deeper. So what does Okta do? In a nutshell, Okta provides cloud-based software that help companies to manage identity and user authentication. They also provide software development kits and APIs for developers' use. Some of its services include single sign-on, for example. This is the type of thing you would encountered from a consumer point of view. Many principles of zero trust at play here. They offer many products. That is not the only thing, of course, but basically this is all to do with user authentication and identity management for enterprise customers mainly. This all fits in the broad field of cybersecurity, and of course the most attractive thing about anything cybersecurity related is the total addressable market. Absolutely huge total addressable market at play here. Clearly, this type of thing, identity management, user authentication, is absolutely necessary for the future of the workforce, displayed in the total addressable market. $80 billion right now, split between $30 billion of customer identity and $50 billion of essentially workplace identity in the total workforce opportunity right now. This is predicted to grow at a good compound annual growth rate, maybe just shy of 10%, but that's decent if you ask me. So 80 billion right now could grow at a decent rate over the coming years, and definitely a lot more in the future. Looking at how the business is performing, some financial metrics, now has just under 16,000 customers, has a 123% net dollar retention rate, which is very impressive, meaning that on average customers spend 23% more every year. This has been coming down over time for full disclosure, but still very good, still guarantees essentially 23% growth depending on churn. Total revenue, 46% compound annual growth rate over the last 3 years. Final one is expected, of course, but this is tremendous growth. This is roughly 3x in 3 years. Very, very impressive. Okta has had a lot of success with big enterprise customers. They have nearly 16,000 customers on the books. Some of these have really value global brands that continue to trust Okta. Some examples being Slack, Adobe. You can read through that list if you really want to, but the point is lots of big brands continue to trust Okta and continue to spend more and more on average. As you can see, the most recent quarter, total revenue up 65% year over year, subscription revenue being the vast majority of that, up 66%, only 4% was professional services and other, which is excellent because this will tend to be the lower margin things. Okta standalone revenue up 39% year over year. Of course, this excludes the revenue from the acquisition of Zero in 2021, which now looks a tremendously expensive acquisition. It was around $6.5 million of mostly stock. So at the time Okta was trading, its market cap was probably 40 billion plus. So it looks, expensive in dollar terms and percentage of market cap, but a good time to use your stock at those elevated prices. Quarterly revenue in 2 years has gone from $183 million to $415 million, continues to increase on a quarter-over-quarter basis at a good rate and really solid growth year over year. Finally, just want to talk about the second half of this graph. Dollar-based net retention rate was actually up 300 basis points, but make no mistake, this is not a particularly strong dollar-based net retention rate. Still good, but not the strongest you'll ever see for a SaaS company. Non-GAAP gross margin, 76%, very, very strong, and even down a bit year over year. Free cash flow margin, 2.7%. This is very, very depressed on what is the normal free cash flow margin of around 20% for this company. And in truth, this is because this is a tough year for businesses, and they've pushed a bit more money to spend elsewhere. I think that's fine. Customers growing at 48% rate. Very, very strong. That means they've added about 5,000 customers this year alone. And customers with more than 100k in account value up 59%. Very, very impressive growth. So having a look at some pros and cons. $80 billion TAM, very, very big. They've barely got any of that at the minute. It's something like 1.5 billion annual run rate, 50% compound annual growth rate. They're growing tremendously, revenue tremendously. All that while being free cash flow positive. Admittedly, the free cash flow margin was only 2.7% this year, down significantly from what it was last year. But in a more normal year, I'm expecting that to be much higher. 70% plus gross margin consistently, 76% gross margin in the most recent quarter, and that was down from where it is, but above 70% is still very, very strong. 11 times sales is, of course, a con. Now, in today's market, when we're valuing things on a price to sales basis, this has to be a con. a higher interest rate environment, stocks like this are going to get hit, and that is what happened when it was trading more than 30 times sales. It looked very, very expensive. Now it just looks expensive. Enterprise value free cash flow is above 150. So while it is free cash flow positive, it's still not free cash flow positive enough. That margin of 2.7%, the decrease from last year is really hurting the valuation here. And one concerning thing that I've taken a much more of a note of in software companies recently is stock-based compensation. The share count did increase in more than 10% this year, which is slightly worrying. However, I believe that as the company matures more and the winds is really changing, I think, in stock-based compensation across the wider market, I think this will decrease rapidly. So overall, I think this is a fantastic company. I'm going to dip my toe in the water myself. But of course, you make your own opinion of that. I'm not a financial advisor, so you make your own opinions. None of this should be counted as financial advice. Let me know if you like the video, like and subscribe if you're enjoying the content. I'll see you next time.